Hi, my name is Dan Nicholson. If you don't know me, I'm the CEO, founder of Nth Degree CPAs. I've got Kyle with me. Kyle's tax director on our team. Kyle's been with me for a decade and really leads a lot of the practice at this point. But just about me briefly, I like to tell people I'm an accidental accountant. I didn't set out to be a CPA. There's a whole backstory to that, but I really consider myself to be an entrepreneur first. And once I finished college, I completed arguably the most prestigious fellowship in accounting, also maybe the most nerdy thing you can do, which is I did a fellowship at the board that writes all the accounting standards. So maybe you've heard the term GAAP, generally accepted accounting principles. So I moved to the East Coast, just outside of New York City, and helped write a derivatives and hedge accounting standard, and then spent the next several years of my life working on that standard, mostly with clients who had $100 billion or more in investable assets. So you can kind of do the math and guess who those businesses and clients might be that would have $100 billion in investable assets. Partly I did that at Deloitte, which is the world's largest CPA firm, but work with various Fortune 500 companies, including a Warren Buffett-backed business, before I noticed that there was a real opportunity to do something different in the CPA space. And as of June 1st of this year, it's been 15 years that I've been running Nth Degree CPAs, really leading with strategic tax advice, helping clients fund the life that they want, and have won some cool awards along the way, and wrote a book called Rigging the Game, which if you're a client or if you want to reach out, be happy to send you a copy of Rigging the Game. With that, let's just jump right in. So from my experience working with small business owners, taxpayers, sort of outside of that billionaire class, notice that there's four primary types of taxpayers. The majority fall into the first bucket, which I call hope and pray, which is they put some information into TurboTax. They give their information to their tax preparer. Maybe their tax preparer is a CPA. Maybe they're not. Maybe they're someone that for the first 3 months of the year, they prepare some tax returns, and they just hope and pray that they're not going to have a large unexpected tax balance. And then if they get a refund, they think the person who prepared their return is a genius and did a great job. If they owe a bunch of money, then they question whether or not that preparer knew what they were doing. So that's where the majority of taxpayers in the US fall under, the hope and pray. Now, there's another type, which is the strategize but never execute. These are the folks who like to watch a bunch of TikToks, Instagram videos where people talk about strategies, talk to their friends about it. Maybe they even go as far as to get a tax plan from someone. And there are a bunch out there over the last couple years that have come into the market utilizing the same approach they use for tax prep, which is they bought a tax planning software, they put a bunch of your information in, they get a report back. The report's basically the same for every client. There's not really any scenario analysis. They give it to the client and they say, here you go. I just showed you how to save a bunch of money in tax. They don't really tell you how to implement it, or now you've got a new job, a new full-time job that you've got to try and figure out how to possibly implement all these technical things. And so then they never execute. And so they end up in the same consequence or same scenario as the person who was hoping and praying. They just put a lot more energy towards it. The third category is that they execute, but they never strategize. It's a smaller section of the population, but these are folks who and I don't want to name names, but a couple influencers that I've gotten emails from bragging about how they reduce their tax bill, and it just involves spending a bunch of money. So they bought a bunch of stuff at the end of the year, and maybe they loaded up some retirement accounts, but there wasn't really any overarching strategy. And these are the folks, if you're familiar with people who are house poor, these are the folks who are tax poor, tax planning poor, which is now they've tied up all their cash in the things that they bought, and they're arguably in a worse position. Maybe they made a point, they got one over to the IRS, but they're in a worse position because they have less cash. And that's really not the point of the game. The point of the game is to minimize your taxes so that you have more cash and more assets so that you can live the life that you want. And that is where our clients sit. That's where you sit, being on this call. which is taking the investor approach. An investor is thinking about what is the long-term return that I might get? What is my overall cash position? In the corporate world, be a technical term, which would be acting with a fiduciary mindset. So if you're a CEO of a Fortune 500 company or any company where you have shareholders, everything you do has to be with this fiduciary approach. What's in the best interest of your stakeholders? And you should be thinking the same way about your own personal financial situation. What's in your long-term best interest? And that's taking the investor approach. 15 years ago, when I started this, less than 1%, maybe 0.1% of the population was taking the investor approach to their tax situation. Of course, these are the ultra high net worth folks. We've chipped away at that. Now I'd say there's more like 5% of the population who are taking this more investor approach towards strategically minimizing their taxes. So you're here, you're going to take that approach. We're going to talk more about how you can do that. And this is exactly what we do for you as a client. Now, I want to come back to, for those of you who read my book, Reading the Game, or work with us as a client, we're constantly talking about how the biggest risk in life is not living the life that you want. And minimizing your taxes is a way to help fund living the life that you want with less risk and less effort. And a quote that I also lean on pretty heavily from W. Edwards Deming, although there's some dispute about if he actually was the one who said this, is that every system is perfectly designed to get the results that it gets. And so if you don't like the results you're getting, you have three options. You can be a victim, which is kind of that hope and pray type approach, or you can try to change the system. In the case of taxes, that's very complicated because you'd have to become elected, do a bunch of lobbying, try to rally everyone to change tax law. Or the last thing is change your behavior within that system. And that's exactly what the ultra high net worth do. That's what the investor approach towards your taxes is all about, is modifying your behavior. Now, maybe that sounds complicated, but the reality is that you already have the skill and expertise to do this. Think about over the course of your life when you've wanted to make better relationships with folks. Maybe you've had to modify your behavior. Maybe you've wanted to get healthier. You've got to modify your behavior. Want to be better at sales. You're modifying your behavior. So there's already so many examples of ways in which you have likely modified your behavior to get a different outcome. And building your wealth tax planning is the exact same approach. So did you know that you can consider over 150 different tax strategies to reduce your taxable income? That 150 number was the same number that we would have told you a week ago, and the same number we would have told you 10 years ago, and roughly the same number I would have told you 15 years ago. Yeah, there are some new things in the big, beautiful bill. Mostly they are an amplification of existing strategies. There are a couple of new things like the no tax on tips and the vehicle interest deduction. Again, most of you aren't likely to qualify for that, but there's already over 150 different tax strategies you can use legally and ethically to reduce your taxable income. I'm not talking about any of the strategies that involve you hiding money in foreign bank accounts or writing a letter to the IRS saying that you withdraw yourself from taxation. If you've ever seen any of those tax scams that are out there, I'm not talking about any of those. These are tax strategies that have court cases, IRS audit manuals, legal opinions, etc. In fact, did you know you could use deductions to reduce any taxable business profits to zero? In other words, you can offset 100% of any income from business profits. Again, I refer back to the over 150 strategies to do exactly that. Did you also know that you can use losses from real estate or other business activities? Because short-term rentals, if you've seen our trainings on short-term rentals qualify as a business activity. You can use losses from that to reduce your taxable, again, business profits by 100%, plus another 626,000 in any other types of income. So that would be for those of you who don't have a business, but you receive income through a W-2. You have interest income, you have dividends, you have capital gains. If you're a married filing joint taxpayer, you can offset up to $626,000 worth of that W-2 income, that interest income, dividends, etc. $313,000 if you're single. This is an $8,000 increase from last year. So typically this limit goes up each year. So if you're on this call right now and you have a W-2 and you make $626,000 or less, you could reduce that to zero and pay no federal income tax. If you're a business owner and you have business profits and your total wages plus interest income, dividends, capital gains is $626,000 or less, we can reduce all of that to zero. Additionally, you can use strategies such as the charitable contribution rules to reduce your taxable income by up to 50%. And I left off this, but you can also use tax credits to reduce your taxable income to zero. So for those of you who are thinking that you needed to wait until the big, beautiful bill came out to reduce your taxable income, the reality is that you have been able to do this for many, many years, decades actually. And really what happened is that there are some ways that reducing your taxable income have become easier. Now, on average, what we see is that small business owners pay 40 to 60%, but sophisticated investors, Fortune 500 companies pay 0 to 20%. And as we just established, there's 150 plus strategies to be considered. So what is the reason why small business owners pay 40 to 60%? I would add individual taxpayers 30 to 50, but sophisticated investors and Fortune 500 companies pay 0 to 20%. And the reason is access and education. And the typical small business owner and W-2 earner, they're using the hope and pray method to their taxes, where they turn in all their information and they hope that they don't owe any additional tax. But the sophisticated investor, Fortune 500 company, they're using that investor mindset. They have that fiduciary responsibility. So they are planning, they're acting like what we call an architect, building their financial picture. And we can go and we can look at things, data to prove this out. So going back to 1980, we had a top-end tax rate of 70%. Now we have a top tax rate of 37. You can see that illustrated in green. The line in blue shows the average tax rate paid by all taxpayers, which is roughly around 15%. So even when we've had higher tax rates, the average has stayed roughly the same. In fact, if you look at the average where the point is in 1980, and you look at where it is in the 2020s, almost exactly the same, fluctuates 1 to 2%. If we were to go back even further to say the 1920s, you see a top tax rate in the 90+%, average tax rate 15%. That's because those who have a lot at stake, they are taking that, what I call investor approach, they're architecting their future. So nothing has really changed today with the big, beautiful bill. Again, other than there's things that make it easier for us to get the outcome. Now, questions you have to ask yourself when you are moving into this investor mindset, where you're taking more of a fiduciary responsibility over your wealth and your tax planning, is that, do you want to turn your money into things that have a long-term benefit? That's a core tenet of tax planning, is acquiring assets that grow your wealth that will also create a resulting tax benefit. If you just want to have more spending money today and buy something today with immediate gratification, tax planning is probably not for you. Now, I would argue that if you do the tax planning first, now you can fund the things that are more immediate gratification. It's just changing the order of operation. Now, are you willing to learn new things, even if it means changing your mind? And if you're on this call, I think you're going to answer yes to this. But from my experience, I get on the calls with a number of folks who are interested in being clients, and then they say, how come my friends don't know about this? And it gets into an interesting conversation. It's kind of hard to give someone the satisfaction that they're looking for, but the reality is it's education and access. You're not learning about how to do tax planning, wealth building in elementary school, middle school, high school. And even if you get a master's in tax, you're not learning about how to do strategic tax planning. Kyle and I can both speak to our experience taking master's in tax classes. You're learning how to be good at preparing tax returns, which is different It's an entirely different career. Now, also, do you want to learn how to take smart risks? And I hope the answer is yes. For you, we need to take risks where there's way more upside than downside. So there's a way in which we get pathologized in the small business community in particular, where people are constantly talking about how you need to burn the boats and go all in uh, as a way to sell you their program. Ironically, if you learn the whole story about burning the boats, it's actually a case study in taking the least amount of risk. And you can, again, get a copy of Rigging the Game where I talk more about that specific story. Just feel free to reach out. So hopefully you're saying yes to all of those. And as we get into this information, this is purely for presentation, general information. This is not customized to your specific situation. Kyle has shared a few times in here a link where you can book a call to talk with our team and make sure that you're at least at a minimum getting something that's more customized to your situation. So you're not in that bucket where you're a hope and pray, in the bucket where you're just watching a bunch of kind of infotainment about what you might be able to do, or you're executing and you find yourself in a position where you're cash poor. All right. So use that link, book a time with the team. We'll help you at no cost, at least get you pointed in the right direction and help you figure out how we can build you an actual implementation plan. That's because you can't solve a strategic problem with tactics. So there's no amount of, if the tactics are just spend a bunch of money, that's not going to get you to the right place if the strategy is how do we build long-term wealth. Now, I want to take a quick detour for a moment and ask each of you to do me a favor, and I want you to figure out roughly how much you actually owe in taxes. So here's a link. So I'm going to ask each of you to go here to mylife.nth-degreecpas.com and put that in there again. And select up here at the top, are you a W-2 earner or are you self-employed? And pick your filing status, single, married, filing joint, head of household. And then put in your current taxable income. And so what if we're both? So if you're both, choose self-employed. So I've tried to make this as simple as possible for illustrative purposes only. Some of you might point out there's also married filing separate. That what about itemized deductions and some of these other more technical things? But this is purely for illustrative purposes. So I'm going to just give an example. Typical client of ours, annual taxable income, 650,000. They're going to work. I'm just going to put in 2,080 hours. That's 40 hours a week. Now the reality is typical clients working more than that, building a business. And let's just say that they've got annual revenues of 2.5 million, and they've got profit margin of about 22%. Now, please put in your actual information into this, and then you hit calculate. Now, what this is going to show you is at the top, based off your income and your filing status, the amount of tax that we would expect that you would owe. This is just federal income tax. And some of you have state income tax, and there's some other factors that might increase this amount, like some of the Medicare surcharge taxes. You might have some other types of income, capital gains otherwise. So this is illustrative. Use the link that Kyle has shared if you want us to give you a more precise number. There's too many variables to keep this simple. And what this is intended to show you is how much additional income would you have to generate in order to have, in this example, $197,520 in cash. And so in this case, you have to have $313,524 to net $197,520. That's because this additional income is going to be subject to tax. So to walk away free and clear of what you're paying in tax currently, you'd need to make nearly double that amount. In your business, using the example that we had of 2.5 million in revenue, 22% profit margin, you'd have to generate $1.4 million in additional revenue to net 313,000 in additional income. Now, how hard would you work to generate $1.425 million in revenue? From my experience working with thousands of business owners at this point, they work really hard to add revenue. They'd spend maybe $1.425 million in marketing to make this amount in revenue. If you were selling your business, you would hope to get 1 times revenue at a minimum. So someone else might spend 1.4 million to buy a business that's generating this kind of revenue, additional revenue. And so the point of this is, how hard would we work? How hard would we have to work? We'd have to work 1,000 more hours to offset all this, or to earn this equivalent amount in cash that we could just offset through legal strategies. Okay. But what's even maybe more illustrative is if we took the average S&P 500 rate of return through the end of the last year, it's been over the last 30 years, the average has been 9%. So if you were to take this 197,000 and reinvest it and get 9% each year, look what happens. So you got 1.2 million after 5 years, 3 million after 10, 10 million after 20, 26, almost 27 million after 30 years. This is just from recovering what you're already paying in tax. So drop a comment. How many of you, just a yes or no, did you do the calculation? So just drop me a yes or no. Did you do the calculation? And then were you surprised by how much additional income or how many additional hours you would have to work to generate that amount in cash after tax? So do me a favor, drop a chat. I lost everyone. Put everyone to sleep. Tyler says, yes, I did it. And yes, it's a ton more revenue. So that's the point. So we're working really, really hard to generate what we could just recover and reallocate, what we could save. So how do we do things with less effort, less risk? We recover what we're already spending on tax. That's the highest leverage thing we can do because it's money that we're already making. We're paying to someone else. We're not getting a return on it. Meanwhile, we're working harder and harder in our business to continue to grow revenue, or you'd have to work another second job in W-2 income to generate an equivalent amount. And so that goes back to, we can't really solve a strategic problem with tactics. If our tactic is just more revenue, that might not be the best approach when strategically we could work significantly less and recover an equivalent amount in tax. So with that, how do we do that? Well, first we start with optimizing entity structure. Should we have LLCs? Should we convert some of those LLCs to S Corp? Should we form a C corporation? We want to think through how to get things best set up. A lot of times people come to us afterwards, after the fact. We need to redo the entity structure, or they're massively overpaying in an additional tax that we didn't show on the calculator, which is called self-employment tax. So we want to get that correct. Then we want to unlock existing benefits so things that we're already entitled to. And one of the biggest benefits right now from the tax bill, the big beautiful bill, is additional bonus depreciation from properties that you may have already purchased this year. So we want to unlock those before we do anything else. And if you're a client, we're going back through those cost segregation estimates and recalculating. And I'm going to show you some examples of some that we've already looked at and how much more additional benefit that you're going to get on your taxes from things that you already own, because you've already been on tax offense, with that investor mindset, putting yourself in the position. Now this bill kicks in, it amplifies what you've already done. You may not have to do anything else. You've already put yourself in that position. Third, we're going to acquire assets with tax benefits that reduce your income below phase out thresholds. So you're going to see, I'll just actually scroll down here. You're going to see as we go through this list, here's a handout. You guys can reach out afterwards and ask for the handout. If you're a client, we'll give this to you. You can see all of the different changes from the big beautiful bill, or updates. Many of these, I'm still scrolling, many of these are super niche, and that's where you benefit as a client from us going through this and telling you which one of these apply. Because a bunch of these, like remittance transfer tax, farmland sales, the base erosion anti-abuse tax probably doesn't apply to you. Some of these foreign rules probably don't. So you can spend a lot of time watching videos and going through all this stuff. We'll tell you which ones specifically apply, but there's a bunch in here, even in things that have gone away, especially around the energy credits. But you'll notice, and I'm going to hand it over to Kyle in a few minutes to talk about more specifics. You're going to notice that there's phase outs. So once you get over a certain income threshold, you do not get the benefit from the strategy. So what we want to do is back up here is we want to acquire assets that get us below the threshold. So now we qualify for the child tax credits and the vehicle interest deductions and the state and local tax deduction. We qualify and we have this multiplicative effect where all of a sudden one strategy puts us into a lower rate, and now we qualify for several more strategies, and now that gets our taxable income to zero. So the key is get yourself in a position so you're below the threshold, so now you qualify. And then we can consider what we call cleanup strategies. These are financial products, things like a medical LLC, leveraged depreciation, tax convertible bonds. These are financial products. They aren't the highest leverage because you aren't acquiring a long-term asset, but they're a strategy that will give you some additional deduction ROI to move your tax liability down potentially the rest of the way. But we end with those strategies usually. Now, we'll still show you in the scenario analysis a mix of different things. One of the things we do differently that you'll see as a client is we're not just giving you one plan of, we're now showing clients several different strategies and mixes so that you can ultimately choose what you want to implement and understand what cash would be required to do so. So optimize your entity structure, unlock what you already have. Then we acquire assets to get us below the phase out thresholds, see what those additional strategies that you now qualify for do for your overall liability, and then we consider any remaining cleanup strategies. That's the strategic approach. The tactical approach is, let me just put some money into a 401k. Let me just pay my kids. Now, we may do the pay your kids strategy, but it all comes back to following a sequence and being consistent. In the finance world, the saying is consistency over accuracy. So we want to consistently plan the same way year after year. And this year, maybe we get your tax liability down by 50 to 80%. Next year, 80 to 100%. We're building that momentum up. Sometimes folks, especially in the strategize but never execute, where they fall victim, is that they think in all or nothing terms. So I'm either going to get my tax liability to zero or I don't do anything. And if you did that calculation, you'll see how much money you're leaving on the table. So even if you reduced it by 50%, it's likely still a significant number. Now, with all of that, the important stuff, because again, it's about strategy and having an approach to things that's first and foremost. Let's talk about the finer points. So the two biggest levers for small business owners is 100% bonus depreciation is restored. It was at 40% this year. And the R&D credit has been corrected. R&D credit is for developing a new product or process that's technological and biological in nature that underwent a process of experimentation. Many of our clients, we identified that you qualify for R&D credit, but there was a defect in the Tax Cuts and Jobs Act where over the last couple of years, claiming the R&D credit would increase your taxable income. And then over time, you would see the benefit. That's been corrected. So if you've been sitting on the sidelines waiting to file amended returns for the last couple of years, we're now putting together a plan now that got added into the bill at the end to get those returns amended. And some of you are going to have a windfall in cash from that. Maybe you've never considered the R&D credit because you think I don't work in technology, but there's over 40 different industries that qualify, like chiropractic care as an example, farming. Some service-based businesses have developed a product or process that's technological or biological in nature. So you may think that you don't qualify, but there's actually many different industries. It's not just specific to technology. It's possible that you qualify now that this credit has been corrected. We're claiming it isn't causing you to increase your taxes. We want to look at reassessing that and amending prior year returns. There's an opportunity to get money back. Now, I kind of skimmed over bonus depreciation because I have a couple of illustrations to show you the impact. If you already bought a short-term rental for this year, and we did an initial cost segregation study, I want to show you how it's likely changed. Or if you're qualified for real estate professional status and you bought some properties, I want to show you how that likely has impacted you. Maybe you bought some equipment as well, but more likely in the real estate space, bonus depreciation is a massive game changer, and it may have resulted in you not necessarily needing to buy any additional properties. But we're going to be looking at that for every client and recalculating the cost segregation studies to see exactly where you're at. So I'll give you an example. So what happens is when you buy a property, by default, if it's a residential property, it's going to be over 27 and a half years that you claim the cost. If it's a commercial building, which short-term rentals would be considered a commercial building, it's over 39 years. But there's this thing called a cost segregation study where an independent engineering company goes through and it looks at the purchase price and it allocates it into these different buckets. And these, such as some of the property that's 5-year, 15-year, and 39-year. Now, why would some things be shorter life for tax purposes? Think about like mechanical, HVAC, things that just break down sooner than like a foundation. So this study comes back and it allocates some of the cost. And so this is an example of one where it was around a $700,000 purchase price. We had $96,043 in 5-year property, $66,000 roughly in 15-year. So under the rules before the Big Beautiful Bill, the 5-year and 15-year would have qualified for bonus, and it would have generated depreciation in total of about $94,000. But with bonus getting kicked back in, you can see that for the 5-year and the 15-year, the amount of depreciation for that qualifying property more than doubled. And so as a consequence, your total first year deduction goes from roughly $94,000 to $176,000. And for most of our clients at a 37% tax rate, you can see that just this change in the rule resulted in an additional $31,000 roughly in tax savings. So if this is your property, you just got an additional $82,000 roughly in depreciation. That's an additional, said another way, $82,000 that's coming off of your taxable income. And so now you don't have to work as hard to reduce your taxable income below the thresholds where now you're going to qualify for some of the other credits and things that you're phased out of. Here's one example. Here's another client example where because of the nature of their property, almost everything qualified as 5-year, meaning almost everything qualifies for bonus depreciation. So on a $735,000 purchase price, roughly, originally they were going to get a write-off of roughly $369,000. Now they're getting a write-off of $709,000. So if you were someone in that $626,000 range as a W-2 earner, you own this property, this purchase just offset your total taxable income to zero. So the moral of the story is this is not a new strategy. We pulled these calculations from existing clients. We already had a plan where we already had an estimate. They're already acting with the investor approach, that fiduciary mindset. And so there's nothing new that they need to do. It's just that the strategy, the thing they're already implementing, just got better, significantly easier for them to offset tax. Again, the strategies are to look at short-term rentals. And so if you're not familiar with the short-term rental strategy, book a call. Kyle's got the link here in the chat, and we can walk you through that. We also have a 15-minute explainer video on how the short-term rental strategy works. But it's not exclusive to, you can do this with long-term rentals. You do this with other equipment as well. But the moral of the story is that it just got easier, more than double, right? Easier to offset your taxable income with an existing strategy. So those are the two biggest pieces. Again, bonus depreciation, R&D credit. Now there's a litany of other things, and I'm going to hand it over to Kyle to kind of walk through. We'll get through as many of these as we can, and then for clients, we're going to be doing a separate Q&A. We're also going to be updating your plans on how this is all impacting you. But the key thing is, if you're just someone who showed up and you're just going to watch the rest of this and you go back to your normal life, you didn't save anything in tax. The key thing is you have to implement. There's no free lunch in this tax bill. All right, Kyle, let's get into the weeds even further.
Cool. Thanks, Dan. As Dan said, there's a lot of stuff in the bill. Some of it more impactful than others. Some of it more relevant for people than others. So we focused first on kind of calling out those things that we see being most impactful. I'm going to run through those. Time permitting, I'll run through everything. But if not, if we can't get through everything, as Dan said, we'll share this handout with people. So bonus depreciation, number one. If you're familiar with bonus depreciation, you're probably aware that it has been kind of tapering off over the last few years. It was 100% starting in 2018, and then as of 2025, it was dropped down to 40%. And so with this increase back to 100%, this applies hugely with real estate, but also applies to any business property. And so at 100%, business property is going to be fully deductible in the year of purchase. Anything that has a life of less than 20 years. So our clients generally are maximizing their depreciation deductions through the opportunities that exist with bonus depreciation. R&D expenses. Dan went through this one with a pretty great summary already. I'll just add a couple clarifying points. So with the change, with the correction to the law around research and development costs, these are now deductible again, where for the last few years, there has been a required capitalization of research costs, meaning instead of deducting them, just writing them off in the year that we incur them, we have to spread those costs out over an extended period. This only applies to domestic or US-based R&D. If you're outsourcing your R&D outside of the United States, we are still required to capitalize those costs, and they'll be spread over 15 years. So as you can imagine, this is an incentive to bring that research and development activity into the United States. If you're familiar with the R&D credit that we've talked about, that R&D credit is based on US-based research and development anyways. So further reason to keep or consider keeping your R&D in the country. You're going to qualify for immediate expensing and the R&D tax credit, and we get to apply this retroactive, so we can go back to 2022 when the laws changed, and we can go back and scoop up any missed opportunities there as well. Next one, Section 179, expensing. Section 179 is often confused with bonus depreciation, as both of these provisions enable a business to write off the cost of business purchases. Bonus depreciation in a lot of cases has some benefits over 179. One of the big ones is bonus depreciation can drive our taxable income negative, and we can use those losses to offset other types of business activities or other types of income, where Section 179 can only drive our business profit to zero. Any excess loss created by Section 179 will carry over to a future year. So one of the things we're always looking at for our clients is which one's going to be more beneficial, bonus depreciation or 179, and we're maximizing those deductions where available. A couple other things here, the QSBS exclusion, sorry. This is your qualified small business stock exclusion. There is an increase in the allowance for an exclusion on the sale of small business stock for those that are holding that stock for less than 5 years. Currently, that qualifies for a 50% exclusion in some cases, with the law change or increasing that to 75%. So minor change there, but could be impactful for those that aren't able to hit the 5-year timeline for QSBS exclusion. Last one, this applies specifically to manufacturing companies. There's a credit available under the current law for those entities that are specifically engaged in manufacturing activities. There's a credit that is based on 25% of your manufacturing activities. It's increasing to 35% after the end of this year. All right, now those were business provisions. Now jumping into the individual provisions, and I'll cruise through these ones because there are a lot here, but again, the impact generally is not major. So tax rates, we're going to see a consistent tax rate that has been in place since 2017. Those preferential tax rates were scheduled to expire in 2025. They're going to be continued now and indexed for inflation. The next one, this is one of those things Dan talked about that won't apply by default to most people, especially those on this call or most of our clients, but by driving your taxable income down, you'll be eligible for this type of deduction. This is the car loan interest deduction. Currently, under the current law, or prior to the BBB, car loan interest was considered personal and was not deductible. With the change, we can deduct up to $10,000 of US-based auto purchases. So if your vehicle was manufactured in the United States, it can qualify for a $10,000 auto loan interest deduction. But we need to see that your AGI, if you're single, is below 100,000. If you're married, is below 200,000. So got to get down into that sweet spot before you'll be able to take advantage of this deduction opportunity. The next one, this one has been talked about a lot, SALT cap, so state and local tax deduction limit. State and local tax deduction is an itemized deduction. So if you're somebody that itemizes your taxes and you live in a state that has high state income taxes, generally you would be subject to this $10,000 limit on your SALT deduction. So it doesn't matter how much state and local tax you pay, you're going to be capped and you can only deduct 10,000. With the change, they've increased that from 10,000. The cap is now 40,000. And they had talked about restricting something called PTET restrictions, which was your opportunity as a business owner to elect to pay your state and local income taxes through your business, where you get to see no limitation on the deduction instead of paying those at the personal level. That whole bit was scrapped. So we can still do PTE elections with pass-through businesses, but we also have a higher state and local tax cap at the personal level. The thing that we look at for our clients is whether those PTE elections, pass-through tax elections, make sense or not, and we optimize around those on an annual basis. QBI deduction, again, this is tied to business owners, pass-through income. If you have income coming in from a partnership, an S corporation, other types of self-employment income, there's a deduction of 20% that exists, subject to a lot of limitations, but generally you can write off 20% of your business income before you're calculating your taxable income. They had talked about increasing that to 23%. It's going to stay fixed at 20%, but is now permanent. It's not going to expire in 25 like it previously was. There are also some changes to the thresholds within there. So it's going to be really important to optimize around those thresholds.
What didn't change is that there's a carve out for service-based businesses. And so there's some limitations and phase outs for the service-based business to be able to qualify for the 20%. So there's still a lot of work that you want to do around, again, getting your income below the threshold so that you're not subject to the phase out, but also how you're optimizing your salary. So part of the calculation looks at salary. And so there's back to entity structure as the first step is we got to get the right entity. And then we need to look at where you're at on the 20% pass through, figure out how to optimize that. And it may mean adjusting your salary accordingly to increase the deduction.
Absolutely. Yeah. Thanks, Dan. Next couple ones, standard deduction has been increased since 2018, essentially double what it was pre-Tax Cuts and Jobs Act era. That has now been made permanent. So standard deductions will continue to be at that increased rate. Also, the child tax credit, that has continued as well. It's going to see a slight bump from $2,000 up to $2,200. $1,400 of that is refundable. The $1,400 piece hasn't changed. They are going to, this is one, made permanent, but two, it's also going to be indexed for inflation. So you should see the child tax credit increase a bit over time.
Yep.
AMT, if AMT is alternative minimum tax. This is a tax that historically would kick in if you did drive your taxable income or your tax liability down below certain thresholds. It would kick in to ensure that you were paying a minimum amount of tax. With the Tax Cuts and Jobs Act in 2017, they made some changes to certain thresholds that essentially made AMT not applicable for most taxpayers. Those changes were set to expire in 2025, but they have now been made permanent. So what does that mean? It means most people still won't have to worry about AMT. Estate and gift tax exemption. The estate and gift tax exemption level was increased back with the Tax Cuts and Jobs Act in 2017, and that has now been made permanent. They have increased the exclusion amount to $15 million for a single person, $30 million for a married filing jointly, and those will continue to be indexed for inflation. So we'll see those amounts go up.
And you care about this number because if you go back to the My Life calculator that I set up and you put in how much tax you're going to save and just simply invest that in the S&P, now you can get higher returns potentially outside of it, not investment advice for me. But you can see how that would project to swelling your estate to a point where you would be subject to the estate tax. And if that's the case, then you want to start thinking about now ways in which back to entity structure that maybe you would give your family members, your potential heirs, maybe equity in businesses or assets when the values are low currently. That's one strategy, some charitable giving. So there's some things that once you see the impact of compounding your tax savings, that even though it's years out in the future and it's not fun to think about, that back to the entity structure, we want to get that correct and be thoughtful of that.
Yeah, thanks, Dan. The next section is around personal exemptions and senior deductions. So you might recall pre-Tax Cuts and Jobs Act, again, pre-2017, individuals and families used to qualify for exemptions based on the number of individuals in the family. Those exemptions went away. Those exemptions continue to be gone. Those are not added back with the bill. They did add a $6,000 senior deduction. So seniors with income below certain thresholds will qualify for a $6,000 deduction. This is the effort to reduce the burden of Social Security income tax. Casualty loss deductions. So again, Tax Cuts and Jobs Act back in 2017 really restricted the ability for taxpayers to recover through tax savings casualty losses from thefts or other types of disasters outside of federally declared disasters. With the new changes with the bill, they kept the federal disasters piece. They made that permanent. They added on certain state disasters that will also be included for deduction opportunity, but still pretty limited there in terms of what we can expect to see. Next, miscellaneous itemized deductions. Those were previously suspended through 2025. This would be for anything that's outside of the standard itemized deductions, state and local taxes, mortgage interest, other types of interest, And charitable giving, historically, we would be able to include as miscellaneous itemized deductions things like investment advisor fees or out-of-pocket job costs for W-2 employees, those types of things. Those are continued to be suspended and have now been made permanent as well. So no deductions for those types of miscellaneous items. A couple other provisions. So clean energy provisions have essentially been wiped out. So there historically were credits, energy credits for things like purchasing electric vehicles, making improvements, energy efficient improvements to residential homes or commercial spaces, and then other credits related to the actual building of commercial facilities. These have essentially all been canceled, some as early as 2025, late in 2025, others stretching out to 2027, but essentially all of those energy credits are going away. International tax provisions, there's a lot that changed with international tax specifically for business activities outside of the United States owned by US-based taxpayers, a number of changes to various rates and thresholds, more nuance there than we really need to get into. The changes were not significant, not like they were back in 2017, but this is something that we look at for our clients that have international footprints to ensure that, one, we're optimizing their ability to take advantage of things like foreign tax credits and other types of deductions that are available. But again, it's fairly in the weeds there. Next, Form 1099-K threshold. So this is for those that sell, realize sales or collect through 1099-K reporting platforms, accept credit cards, that sort of thing. The threshold was set at 600, which meant if you were collecting payments of more than $600 through a payment platform during the year, that platform would issue you a 1099-K. That threshold has changed. It went from 600 to 20,000. So now 20,000 or 200 transactions, as long as you're underneath those thresholds, you're not going to be issued a 1099-K. Why was this an issue? We did see fairly often where even individuals were getting 1099-Ks from platforms like PayPal. If they sold a couple of things at the personal level during the year, they'd get issued this 1099-K, and it kind of created a tax hassle for them. So this was a change that hopefully decreases the administrative burden on people. The 1099 standard or miscellaneous and 1099 reporting threshold has been 600 for more than the last decade or so. It's now been increased to $2,000. And so if you're a business that makes payments to individuals or non-corporate entities for services, you're probably familiar with the need to issue 1099s on an annual basis. Now, instead of a $600 threshold, we're looking at a $2,000 threshold that will continue to increase with time.
Okay. All right. So you got through the biggest pieces of the legislation, and we managed to do it just under the 1 hour mark. Now you'll notice, as this is sort of an appendix to our deck, is that as I scroll through this, there are a lot more additional details that are in here. So if you're someone who wants all of these details, you're going to get an email that's going to come from me that should have a link to this recording. And if you want all these details, you can respond, and I'll send you the deck, and you can have all of this. We just tried to hit on the big points, but this is a 1,000-page plus bill. So there are a lot of kind of finer points that don't necessarily apply to most folks, but if it does apply to you, it could be significant. So that's where the expertise of really going through your situation and analyzing it is key, and we'll certainly do that for you. Now, what needs to happen next is you got to take this information, update your plan, make sure you're running it through having a philosophical approach. So we're now summertime for CPAs. supposed to be typical CPA, I guess, is still chill because they're just filing returns. But usually this is a little bit of a lull for us, but we've got some work to do to update everyone's plans based off how these uh, mostly rates have changed. The big thing again, bonus depreciation. So not really anything new, but things got better and easier if you're on offense, if you have a plan. So I shared the link to the short-term rental strategy. That's more of a kind of explainer video on how it works. I also shared our introductory video that kind of talks more about the importance of tax planning. And then if you want to learn more about the investor mindset, how to build a dream team and architect your future, that's what this rigging the game link is all about. And then Kyle, if you wouldn't mind pasting in the calendar link again. If anyone wants to chat with the team, we'll make ourselves available as much as we can over the next couple of weeks to get you on the right path. And just spend some more time just thinking about not only how much tax you could recover, how much effort it would take to do that in terms of working more hours, growing your revenue. And then think about some of the goals that you have. The number I showed up on the screen was a large number, a couple 100,000 common scenario for our clients. But maybe your dream is a specific car you want to buy, or maybe you want to go on a really nice trip to Maui. How many times could you go on that trip to Maui with the potential tax savings? So that's how saving tax helps you live the life that you want. So appreciate you tuning in.